Guys, in today's topic we're going to talk about correction. I know this part can be a bit confusing, but I'm going to try my best and explain it to the best of my ability so you guys can understand. So correction happens after the market creates a new high or a new low. And as we speak in the last video, we spoke about indication. We stated that indication happens after when it breaks a previous swing high or a swing low. So after the indication happens here, right? It breaks. Surprise would have broken the indication right here, right? So it breaks, it creates an indication, right, guys? So indication happens after price break a swing high or a swing low, right? So now we want to know about the correction part. So a correction happens after the market creates a new high. So when the market comes right here, it comes into a level of sellers right here, and then the market reverse and come back to this level, right? This level that it come back to, we call it correction. The market is correcting, right? The market is coming for your stop loss, because you would have had your stop loss above below this previous level right here, and the market will sometimes correct itself all the way under this level, and sometimes the market will not. The market will come here, right, and then go up, or it will come part way and then continue it up. So it happens after the market creates a new high and a new low, right? So the reason why the market corrects, the market is there to make money, and you know that when an indication happens, you have some traders that are going to enter the market. They're called breakout traders, right? They're just going to jump into the market. They're going to enter the market and say, okay, the market is buying because it push across this level, it break out, and I'm going to buy. And the market reverse, take out their stop loss, and then continue in the direction that they initially wanted the market to go. That is what we are avoiding when we wait on the correction. All right, so this part where the market reverse right after it breaks a previous level, a previous swing high, or a previous higher high, because this would have been a higher high or same high. After the market breaks that level, all right, indicates it corrects. We always want to see the market corrects before we enter. All right, so these are some examples. This is a consolidation correction example. This is uptrend or buyers or bullish trend example. So let's get into it. So right here, so let me show you guys some examples. So right here we have an indication. The market indicates when price reach to this level up here, right, the price start reversing, comes back down to where it indicates. This part right here, this is the correction, right? Right here where you see the level come back down, this part is the correction. All right, the market indicates again right at this level again. The market indicates, and then the market corrects, come all the way under here. The market corrects, come all the way under here. This is the correction. Again, we have the indication, because price is going to break this level right here. So this is the indication right here. When price reach a level of sellers, it corrects, come back down into the indication. Not every time price is going to come back to that level. Right here again, we have breakout, and remember when a price break a previous swing high or swing low, it indicates. So we have a indication and then a correction. Let's say this correction comes right here. It can correct come midway. It doesn't have to correct come all the way back and then continues. So this is how the market moves. So we have an indication, then it corrects. Right where you see the level, all of these level where you see price bounce, right here, correction happening. Come to this level, start to bounce off, correction happening. All right, so that is what we call the correction. So on the sell side, same thing. You know, I'm going to show you the indication. So we're going to put the indication in red. So indicated, sell side indicates the buyers push up back the market. This is the correction. Right here again, we have the price. It indicates sell. The red mean sellers push the market down. Right here, it meets a level of buyers. It corrects. Corrects go all the way back to the level where it indicated from. Again, right here, we call this the swing high. Draw the line. Again, price indicates right here. It push back below the level. This is the correction. In the green, it corrects. Again, we draw the line, come all the way across. We see the indication. And then what happened? Price corrects, come all the way back. All the way back here. And this is what we call a correction. Oh, this is supposed to be in green. Sorry about that, y'all. Yeah, price corrects, come all the way back. And price indicates, and then corrects, come all the way here. And this is what we call, let me show you all. Let me write it up. Indication. Indications are in red. And then the corrections are in green. All right, so we have the correction there in the green. And this is how the market operates, guys. So we have our lower low, lower low, lower low, lower low, lower high, lower high, lower high, lower high. All right. All right, when price indicates, and then reach this level right here, and then it push up back where the correction happened, it forms a lower high. Right? This is market structure. Then the price push down indicates past this lower low that it recently created, you know. And then what happened again? It forms our next lower low. And then the market reverse corrects to form a lower high. Then the market come back down. It indicates to form a lower low. Then the market reverse to form a lower high. Lower high. Then the market indicates to form what? A lower low. Then it corrects to form a lower high. Una get it? Tell me say una get it. Una get it? So this is how the market moves, and things to know. Correction are not always going to return to the previous level it breaks out from, right? Correction happens so that you can take out the fear of missing out traders. We call them FOMO, fear of missing out traders and greedy traders. So like example, we do not trade the indication. The fear of missing out traders examples when you have a breakout and you're like, you see this big candlestick go up and you're like, okay, I missed out on the trade, I'm going to enter now. You enter, the market reverse, and then take you out. And the revengeful traders now, them greedy. Them miss the trade, them see the market as sell, so them jump in at the trade, and then the market are going to stop them out eventually. So we do not trade indication. Breakout traders do that. And we do not trade correction. Revenge traders do that. So after them hurry up and enter the breakout and the market reverse and hit and stop loss, they want to enter back again. So we don't trade that. We wait on the continuation. So let's go over to the chart for some examples. Please remember that indication happens after the after price breaks a swing high or a swing low, and then correction happen after the market creates a new high or a new low. So this is the swing low right here. When price breaks, it indicates it forms a new high, right? So okay, a new high is formed. We draw the line, and then when we see the price rejecting, then we know that yes, this is the correction. Right where you see the rejecting happen. So if you want to see more clearly, you can go down to the 1 hour time frame where it give you more information. So we see that price corrected coming all the way back down into this level, right? All the way back down here, we see price corrected too. So let me show you now. So we're going to put this in green. Indication. And the correction in red. So the green is the indication. And then the red is the correction. So the green is the indication level, and then the red is the correction. We're not going to speak about continuation until the next level, until the next lesson. Okay, guys? So, yeah, so the indication happened, corrected. All right, go back up to the 24-hour time frame. All right, where was the next level of indication? So indication happens when the market creates a new high or new low. The new high is right there. We draw the box, we draw the line, come all the way across, right? So right there, this is our new high that the indication happened. It stopped, and then we see the red candlestick start rejecting. To have more information on this, we'll go down to the 4-hour time frame, right? Go down to the 4-hour time frame. We see price come back at below this level, right? Price do not have to always come here. So let me draw it again. This green box right here is indicate. This is indication, right? And then this in red is the correction. All right. If you want to see more structure, we go down to the lower time frame. We see price do not always have to come back to the level where indicated. Once it's above that level, it is showing bullishness. So when price corrects, it forms a lower high. So we see this made a low, a lower low, a lower high, a lower high, a lower low, lower high, lower low. Then price start making a high, a higher high. Then we know that the market is changing direction above right here. Then we know that, okay, the market is no longer correcting now. The market is now ready to continue to buy. All right, don't want to get you all confused, so let me go on explain a little bit further. All right, so we'll go back on the 24-hour time frame. Zoom, zoom, zoom. Where is the next level of indication? Believe it or not, the next level of indication is right here. Next level of indication is right here. Why? How we know? Because it breaks this level where price recently indicated from. The candlestick open and close above this level. It breaks, so it indicates again, even though it's small, even though it's little. Let me fix this red line properly. Even though it's little, price still indicated above this level. We go down to the 4-hour or the 1 hour or the 30 minutes, whichever one that you're seeing structure on, honestly. So we draw the box again. The green shows the indication, indicates. The red box shows the correction. The green shows the indication. This shows the correction. This is the correction. Once price is back above this level where it indicated from, we enter the trade. We go back to the 24-hour time frame again. Okay, where is the next higher high? Where is the next level of indication? Because remember, when price breaks a previous swing high, which was right here, the last swing high right here, it creates a new high. The new high created is right here. Right? That's where it price stop, price bounce back, go down, corrected, continued again. And you're going to continue to move from time frame to time frame to see when the correction ends. So it indicated again right here, right? What we're going to do, we're going to draw a line across again, and then we would enter the trade. Even though this candlestick looks small, when you drop to the lower time frame, this is a lot of pips. You understand? It indicates again, it creates a lower high, it corrects right here where the red candlesticks are, and then price push back above this level again. What happened? Indication. When price push back above this level, indicates correct, right? Again, we draw the line where the indication ended. We draw the line. We wait for price to break above this level, indicates, corrects, continued. And now that's where price is. So this is the buy side. I'm going to see if I find a sell side example. All right, so let's use over this side. Remember, indication happens after the market creates a new high or a new low. All right, so this was our swing low, and this up here was our swing high. Swing high, swing low. We are looking for an indication. I know some of you would say the indication is here, but believe me, the indication is right here. Right at this candlestick that you see, the red candlestick push out right here. This is the indication. We drop to the 4-hour time frame. We see price indicated, corrected, continued. Right? And if you enter these on the lower time frame, you'd have made money because it come back to the level TP would have been hit. All right? Go back to the 24-hour time frame. We draw up again because price creates a new low. Right? Creates a new low right there. Right here where the candlestick close and then start to bounce back. So price indicates, correct, continued. Let me draw the boxes again. This time we're going to put the indication in red, the correction in green. All right, guys, we drop to the lower time frame, the 1-hour time frame. Maybe it's not going to show me on the 1-hour time frame because I'm just showing you. Yes, so it indicates, corrects, right? Go on the 24 again. We draw right where the last lower low is at. Lower low is right here. So we want to see a candlestick closure. We want to see a candlestick closure open outside this lower low right here. This is it. It indicates corrected, continued, and the correct go all the way back up here, continued, right? This is a last lower low right here again. Lower low. Price indicates this red candlestick, right? It corrected, continued. How we know when price is going to change direction? When price breaks this level, price is no longer bullish. Because if price was bullish when price breaks this level, it would have come back. Price is no longer bearish. Because when price breaks this level, we're looking for price to come back. As long as price don't come back to this level right here and push under, then we know we're no longer bearish. We're no longer selling. We're no buying. Right? And that's how the market is, and I hope you guys understand this breakdown. Please again do your homework, go over the charts, mark up your indication, your correction, your continuation, your indication and your correction, because we haven't got into continuation as yet. It can be a little bit tricky, or just open your eyes and look in. Even if it is one candlestick on the 24-hour that time frame that shows that it indicates, we're going to drop to the lower time frame to see the correction happened. So yeah guys, so homework again, mark up the correction, and then the next video we're going to go in depth, which is entries slash continuation. Then the correction in green. Alright guys, we jump to the lower time frame, the 1 hour time frame. Maybe it's not going to show me on the 1 hour time frame because I'm just showing you. Yes, so it indicates, corrects, right? Go on the 24 again. We draw right where the last lower low is at. Lower low is right here. So we want to see a candlestick closure. We want to see a candlestick closure open outside this lower, outside this lower low right here. This is it. It indicates corrected, continued, and the correct go all the way back up here, continued, right? This is a last lower low right here again. Lower low. Price indicates this red candlestick, right? It corrected, continued. How we know when price is going to change direction? When price breaks this level, price is no longer bullish. Because if price was bullish when price breaks this level, it would have come back. Price is no longer bearish. Because when price breaks this level, we're looking for price to come back. As long as price don't come back to this level right here, and push under, then we know we're no longer bearish. We're no longer selling. We're no buying. Right? And that's how the market is. And I hope you guys understand this breakdown. Please, again, do your homework, go over the charts, mark up your indication, your correction, your continuation, your indication and your correction, because we haven't gotten to continuation as yet. It can be a little bit tricky, or just open your eyes and look in. Even if it is one candlestick on the 24-hour that time frame that shows that it indicates, we're going to drop to the lower time frame to see the correction happen. So yeah guys, so homework again, mark up the correction, and then the next video we're going to go in depth, which is entries / continuation.